Hello, my name is Rolev de Wijs.
Hello, my name is Joost de Vries, and together with Rolev we wrote a very interesting book. And why is this really interesting? It's called Corporate Finance for Lawyers, but what we found is that in a lot of books that is published about corporate finance, there are several items lacking, which are really being used in reality. And this is what we're going to discuss with you.
All right, so as an overview of the things we found lacking in other corporate finance book and which are a very important element in our book are the 6 elements. First of all, insolvency as a balance sheet concept. We can discuss healthy companies with good solvency, but the flip side of the coin is of course unhealthy companies, and the concept of insolvency is key to understanding the world of corporate finance. Second element, a popular way of financing is by means of non-interest-bearing debt. If you have to choose between interest-bearing and non-interest-bearing debt, interest-bearing debt is the way to go, of course. The third element, often not discussed in corporate finance books, is what is secured credit actually being used for? Is it used to make investments, or is it used to facilitate returns to shareholders? Very exciting topic from my point of view is financing by means of shareholder loans. So what happens if the equity provider also acts as a creditor? Fifth, slightly more exotic, but also very prevalent in everyday practice, is that shareholders finance by means of guarantees instead of equity directly. And the sixth element we discuss are the reorganizations in a legal sense rather than in the business sense. So these are 6 elements lacking in most corporate finance book, and which we integrated also to make corporate finance relevant for everyday practice.
So, each 6 elements we're going to discuss in a short movie. And this is the first one, so we're going to discuss insolvency as a balance sheet concept.
Joost, in order to explain finance to lawyers, you've developed a tool called the Financial Mindmap. Can you explain to us the Financial Mindmap and also the sometimes enigmatic concept of equity?
Yeah, of course. So the Financial Mindmap, we use it throughout the book to explain complex finance items, but it's in nature very, very easy. So what you find over here on this slide is a balance sheet and a profit and loss account. So those are the very easy concepts of finance. And what you will find over here on the left-hand side is all the assets in the balance sheet. They're depicted in green as a color, being a positive color, since having assets is okay. And then on the other side of the balance sheet you will find a story how this company has been financed. And we have different flavors, and we can, for example, have a flavor which is interest-bearing debt, so that tends to be at the bank from time to time. Then we've got non-interest-bearing debt, so those people tend to be the trade creditors. And then we have this strange block, which is called equity. And equity, Rolev, basically is an accounting equation. It's only the difference between what you have on the asset side minus what you owe to other people. And then there's this residual position which turns out to be the blue block. And actually I had to make a color for equity, and I came up with blue because blue is the color of air, because it's nothing. Right? So this is the balance sheet, and on the right hand side you see the profit and loss account.
All right. Can you also tell us how equity moves depending on success or failures of the company?
Yeah, so the main driver of the blue block in the balance sheet is your profit and loss account. So that means if you're doing well, you're generating a healthy turnover and your cost is less than that, then you will generate a profit. So I'm going to show you on the screen how this works. So let's assume that this company is generating turnover and they're generating a profit. And what you will find is profit will go up, and profit and equity are directly related. So profits will be added to the blue block in the balance sheet. So and then of course there needs to be another change in the balance sheet, because it should be balancing. This is why we call it a balance sheet. So what you will find, so very easy, if you sell more than you have in cost, then probably your cash position will go up. So this is the basic driver of the blue block. But it can also work the other way around. And this is where you start running into losses. And of course, then that means that your turnover is going down, so your losses will go down, and let's assume that it's really bad. Then you run into losses, and then what you see is that those losses, they will eat up your blue block. And over here you see there is hardly any equity left. It means for those companies probably there is no more cash left because they run into losses. And there are still some debt to be financed. For example, the trade creditors are doing their bit. So those are the two drivers that in 99% of the cases drive equity. So profits will make it go up and losses will make it go down.
All right, thank you so much. Joost, you just left us with a company which was suffering losses and was left with very little equity, but it still had positive equity.
Yes, yes.
Can you show us what happens if such a company continues to incur losses? What happens then to the balance sheet and equity?
Yeah, I will show you a very insolvent company. So probably what is the case is those people are having really heavy losses. Let's show you how that works. So probably they have a limited amount of turnover. So this is one problem. And of course they have too many costs. And basically what you see over here, that you run into tremendous losses. And basically what happens then is that your equity can turn negative. And that actually means that there's a negative position. So let's balance the balance sheet first. So probably if you have so much losses, there's no cash left. And probably you stopped paying all your trade creditors because you just don't have the money. So basically what you see over here is a balance sheet with negative equity. Your assets have a lower value than the debt that you owe to other people.
So the what if item is negative.
Yeah, the what if item is negative. And then of course from a legal perspective, that's an interesting question. So what does that mean from the position of the shareholder? Do they have to solve this issue?
Yeah, so you ask if they are forced somehow to make up for the shortfall of 70.
Yeah.
And I think this is the whole essence of corporate finance rather than personal finance. So the whole idea of corporate finance is that we're dealing with limited liability companies. So the limited liability refers to the shareholders, that they're not forced to make up for the losses. So here they may have lost their initial investment, but they cannot be forced by the creditors to pay up for the shortfall of 70. And that's the whole hallmark of corporate finance of all companies. And a bit to our surprise, this flip side of corporate finance, if things go wrong, is not discussed anywhere. It's also not conceptualized.
Yeah, and so of course, if you are one of the players in the financing structure, whether you're a bank, a red block person, or you're a trade creditor, orange block person, when this happens, you run into a risk scenario. And then the question is, who is going to take the pain? So in the next question, of course, is if you are in this situation, how can you fix it? And there are several ways to look at it. And first we're going to show you what the solutions are that do not work.
Yeah, so I think it's a very good exercise to actually understand the working of balance sheet to address this situation. So how can we restore equity? How can we restore solvency of an insolvent company? Joost, you showed us a company which was balance sheet insolvent. Of course, in the end, we can always liquidate a company, but we can also try to restore solvency. Can you explain to us how you can do this? And we've been doing this a lot with our students. And can you also maybe first start by showing what doesn't work?
Yeah, so basically, if you are insolvent, then probably people will think you need money, right? So one of the things that you might consider is that you go to the bank and then you ask the bank for an additional loan. The question then is, what happens in the balance sheet and does it restore solvency? So let me show that to you. You go to the bank and you ask the banker to give you an additional loan. So your red block will go up. Probably then on the other side of the balance sheet, the loan will result in a higher amount of cash. But basically, let's take a look what happened. So the bank block went up and cash went up with the same amount, but from an equity perspective, nothing happened. So you did not restore solvency. The only thing that happened is that you've got more cash available by borrowing more money from the bank. So this is one that doesn't work.
Yeah, so the first that doesn't work, so we started out with negative equity of minus 70. We went to the bank, borrowed money,
Yeah.
cash goes up, debt goes up, equity remains the same.
Remains exactly the same. So this is one that doesn't restore your solvency. And then you've got another one that people use, and that is by repaying your creditor. So let's assume that you do that. So you just borrowed money and you've got people knocking at your door they want the money because otherwise they're not going to supply the products anymore, and that you're going to pay them. So actually what happens is what I can show you. So basically you start paying your trade creditors, and of course this position goes down, and what you need for that, of course, is money. So that's the money you just borrowed from the bank. But again, it's the same balance sheet movement on the left-hand side and the right-hand side. So your cash goes down, your trade credits goes down, and then solvency remains exactly the same. So you didn't fix your negative equity.
Yeah. So a second way of addressing, an attempt to address insolvency that doesn't work. So in the Netherlands we also say no one ever got poorer by paying off its creditor, but you also don't get richer.
Yeah,
paying.
so basically,
So it doesn't work. The second attempt to restore solvency by paying aggressive creditors doesn't fix the problem.
Yeah, and then you've got the third flavor, and this is of course when you end up at the wrong department of the bank, then they want to minimize the risk. So they say, I want you to repay my position, and you have to sell off your assets. So basically the line of reasoning is that you start selling off, for example, your fixed assets. And then, of course, if your fixed assets go down, then your cash goes up. So, and then you use this cash in order to repay the bank. So then again, it goes over here, and then your cash goes down with the same amount. And basically, what you see is that the equity didn't change out of all these steps. And furthermore, and even more worse, if you have to sell off your assets in a fire sale, then probably you will get less than the value that you find in your balance sheet. So basically, then your insolvency problem gets even bigger because you have to sell it off for less than what it's listed for in your balance sheet. So these are the three ways that you might come up with to generate money, but it's not going to solve your balance sheet insolvency problem.
All right. Then we turn to the ways that do work.
Yeah, the ways that do work.
You showed us 3 ways that didn't work to restore solvency. Can you also show what does work?
Yeah, Rolf, so what most companies try to do is when you move in towards insolvency or you are already insolvent, is that you start working on your profit and loss account. So that was the problem that caused the insolvency in the first place. So what they tend to do is, of course, they start reducing costs. So cost cutting is one thing, and let me show you what happens then. So if you start cost cutting, then probably you will restore profitability. So your losses get less, and of course you try to find more turnover. And then if your turnover goes up, you switch from being into losses, and then you end up in a profitable situation anymore. Again. So basically what happens is your blue block is restored by the fact that you're running into profits again. And let's balance it over here with the cash position. But of course, in reality, that doesn't happen because you are repaying your debtors, so the banks and your creditors, during the time frame that you're restoring profitability. The question though is, do those people that finance your business are willing to give you the time to fix this? Because it's unsecure, it's in the future, and probably again, for reducing costs, firing people, you need money. So basically the question then is, who is going to fund that? But the first step in restoring solvency is make your business profitable again.
So we are trying to understand how to restore solvency of a struggling company. We understand that restoring profitability is one approach. What else can we do?
Yeah, so when a company is working on restoring profitability, probably they do need cash in the meantime to solve issues, right? So there are creditors that needs to be paid, or you have to fire people, etc., etc. And one of the flavors then that you can use is go to the shareholder and ask for new money. So basically what they can do is they can issue new shares, or they can make a contribution in the form of, for example, a share premium. So basically what happens over here is, I'm going to show you in the Financial Mindmap. So the shareholder brings new cash into the company. So because the company is issuing new shares, and the shareholder has to contribute in cash, and this is what restores equity on the other side of the balance sheet. So this is the shareholder that brings in new money. But of course, the shareholder asks the question, is it going to be a viable investment? And is the profit and loss account going to work? And what about the other amount of debt in the balance sheet? So, but this is one way you can solve it. You go to the shareholder and ask for new money. Cash goes up and the blue block goes up.
Yeah, I really like the that on two sides of the balance sheet something has to happen. So you cannot just infuse only equity. So you cannot just restore equity by only working on the right side of the balance. So also on the left side of the balance something will happen. And with the equity cure, it's the shareholder contributing new money to the company.
So basically this is what it is. Cash goes up and the blue block goes up, and this is how you restore an insolvent business.
So we discussed two ways to restore solvency. First, restoring profitability. Second, the equity cure. But there's also a third way, which is increasingly popular, also that legislators try to facilitate this more, is that you look at your creditors by having a debt restructuring. Can you also show us how that works?
Yes, so basically this is not the shareholder making a contribution or restoring your profitability, but you go to the ones that finance your balance sheet, and it can be interest-bearing debt, so banks, or it can be creditors. So probably you end up in a discussion where you say, if you are not going to help me out, I'm going to go bankrupt anyway, and probably you're not going to get any money. So if you're going to help me out by having a haircut, then there is still a chance that you get some money, and I can go ahead, and maybe then the shareholder will put in new money. So what do you think about it? So basically what happens then is, for example, you go to the trade creditors and you convince them to take a haircut of a huge amount of their position. So basically this is what I'm doing over here. You just say you wipe away part of your claim, and basically it goes to the position of the shareholder. So basically this is a write-down of debt. So we saw three flavors: restoring profitability, the shareholder making new equity contribution, and this is the haircut. So it's a write-down of debt. So these are the flavors that you can use to restore a insolvent company.
Yeah. So you discussed that you can go to the creditors and put a plan to them, convince them, saying, well, this is at least better than that the company goes bankrupt. But of course you can also force creditors. So then you put a plan to them. That's very much the Chapter 11 mindset, and which is also increasingly popular in Europe, that you have a forced debt write-down and other people vote, but in the end, also if you do not agree, you can be caught in a class, or you can be crammed down in a plan, where also if you do not agree, that you end up being written down or a forced haircut.
Yeah, so and that's interesting. Let's take a look at the cover of our book. What it actually says, it says understanding the power balance between shareholders, secured lenders and unsecured creditors. And basically this is what happens if you start restructuring. There is debate between these blocks, and there is a difference in risk profile, and the question is who's going to take the pain and who's going to fix it. So Rolf, what we've been looking at is the negative equity position from a financial perspective. So we showed the balance sheet, we showed equity, negative equity, and how to fix it. But the question from a legal point of view is the negative equity some kind of magical line? So what do you think about it?
All right, the magical line of zero solvency. So I think it's crucial for lawyers to understand that, in a sense, it is magical, because if you continue operating, if the company doesn't do anything and it just hopes for better days, the additional losses will not be borne by the shareholders. So additional losses, equity becomes more negative, but in fact the risk is actually borne by creditors. So this also triggers the question whether we should attach legal consequences to the zero solvency. So some jurisdictions, for example Germany, they say if you become insolvent, if you have more debts than the value of the asset, if you're überschuldet, then as a starting position you have to file for insolvency.
You have to do it.
Yes.
Yeah.
So unless, es sei denn in German, unless there is a prospect that you can trade yourself out of insolvency, but then there has to be a very good plan. So in some jurisdictions there is a magical line, also legally, and the reasoning behind it is we have limited liability, shareholders do not need to contribute to the losses, but also poses risks to people dealing with the company. So once you run into loss and you have negative equity, either you liquidate or you address the problem in a quick and efficient manner.
So if you look at an insolvent balance sheet, it probably will give you a sign there is pain that needs to be distributed by different players in the game.
Yes.
Yes. And then you should be aware of the fact from a legal point of view, what their point of view is and what the rights they have associated to their position, right? So this is the shifting game and the power balance.
Yes. So also the whole negative equity. So if there's enough, If there's enough value, then there's no friction. So the whole idea of limited liability is only relevant for insolvent, well, mostly relevant for insolvent company. If you can pay your creditors, nobody really cares about the shareholders being liable or not. So the negative equity is basically the starting position to understand a lot of legal rules in place.
So we fixed one issue that's not covered in a lot of corporate finance book. That's negative equity. And we think it's really relevant, and you can find more background information, of course, in the book.
Thank you.